Hello and welcome to this edition of the Open House. You're here on the Money Mile on Facebook. We are live. We take questions from all our viewers who keep posting them. We've got lots of questions today as well to take. Those of you who are tuning in, please feel free to drop in a question. We'll be happy to answer all of them. As always, joining me is Surya Bhatia, well-known certified financial planner, to answer all your questions. Lots of questions, Surya, which have been coming in. That's and Surya Biswas has this question. Let's start with that first up. He says he started his SIPs in July of 2017 in 3 funds. He picked up SBI Blue Chip, where he did a 2,000 per month SIP, a Kotak Standard Multi-Cap of 2,000 per month, and HDFC Balanced Fund also of 2,000 per month, with a view to acquire 5 lakh rupees in 5 to 6 years. Now he wants to stop investing in HDFC Balanced Fund, not switching, but he wants to stop investing. And he wants to start an SIP of 2,000 in HDFC Mid-Cap Opportunity Fund. Is this advisable, he asks. He also says, I am planning to do this because my portfolio lacks a mid-cap scheme. I have also started an SIP of 1,000 rupees in SBI Magnum Low Duration Fund, which is an ultra short-term debt fund.
Look at this, Saurav. I think you have 3 funds right now with you. 2 large cap oriented funds, both SBI Blue Chip and the Kotak Standard Multi-Cap erstwhile, which was called as the Kotak Select Focus. Now both are very good funds, and the only challenge is there is no need for you to have 2 large cap in the portfolio when your portfolio size is only 3 funds. Now HDFC Balance in itself is a very good fund, stalwart in the performance as far as the balance space is concerned, headed by a fund manager, top of the chart by Chirag. So excellent fund. But your concern of removing the balance fund is because you want to add on to a mid-cap which lacks in your portfolio. If that's the only constraint, I think you should get out of one of the large cap oriented funds or the 2 funds which you carry, and then add your mid-cap, which is HDFC Mid-Cap Opportunities. That also is a good fund. So then you're actually creating a portfolio of 1 large cap, 1 mid-cap and 1 balance fund. Going forward, if you want, you can also add a multi-cap space, multi-cap fund in your portfolio, which will actually sum up your portfolio by having all assets in all the right categories of asset allocation. Yes, as per the recent SEBI directive, you have having lot of changes happening in the categories being created now by the fund houses. So, but right now you can focus on these 4. And once the dust settles down, we know how many categories are there. It's actually known, to be honest. But I think once more clarity sets in, then you can tweak your portfolio going forward. Starting an SIP in a low duration on an ultra short-term fund is a good strategy, provided this is done for the purpose of having an emergency or a contingency corpus. If that's the case, please go ahead. And the targeted amount which you are having of 6,000 a month, you are saving, assuming you save for 6 years, it becomes a principal corpus of 4.32 lakhs. At 12% CAGR, you actually cross your 6 lakhs of mark, which means you are able to get to your target. However, if you are coming close to it, and markets go down, therefore the need of the hour should be gradually get out of the portfolio from the equities and the balance to the debt funds, so that there is no dip in the value in case market tanks for any small reason, which can have a dent on your portfolio reasons.
Okay, there's a question coming in from Arindam Biswas now, live. Thanks very much, Arindam. I'm glad that you're watching this edition of the Open House. My portfolio is Kotak Standard Multi-Cap, that is 10,000 rupees. Motilal Multi-Cap 35, that is another 10,000 rupees. Mirai Asset Emerging Blue Chip, that is 20,000 rupees. And DSP BlackRock Small Cap, 5,000 rupees per month. Please confirm whether my portfolio is good or not.
See, look at this. You have a Kotak, which is large cap, Motilal a multi-cap, Mirai a mid-cap, and you have a small cap fund also. Your exposure to mid-caps and small caps are pretty high. On the total saving which you do of 45,000 rupees, 25,000 is actually concentrated in the mid-cap and the small cap space. So if you are comfortable and have a long horizon, we repeat, long horizon over here actually means 7 years and not less than that. It's no more of 4-5 years. 4-5 years we'll always say about equities is meant for typically large caps and multi-cap strategies. Sectoral, thematic, typically all these funds are more of flavors, so these strategies should be used for short term, but mid-cap strategies are actually meant for long term. 7 years, minimum 5, ideally 7 is a period. If you can continue with that, stomach that volatility which will be there in the markets for the next 1 year for sure, can continue further, only then continue with this strategy. Yes, it will pay you well, but in the long run.
Okay, here's a question coming in from Avijit, and he has multiple questions, so I'll go one by one. Avijit is 31 years old. He earns 40,000 rupees a month. He has 3 questions. Let's go one by one.
Yep.
His first question is, I have recently changed my multi-cap fund from Motilal Oswal Multi-Cap 35 to Axis Focus 25 fund because Motilal Oswal is not working well. Is this the right decision?
See, both funds are excellent funds, both Motilal Oswal Multi-Cap 35 as well as Axis Focused Fund. Both are good multi-cap strategies. Sometimes some fund does better, sometimes some other fund does better. So you cannot really hold one fund to ransom saying, okay, you are not performing for the last 1 month, I will actually ditch you and go to another fund. When you look at a fund's performance, please look at long term, at least 6 months, 9 months to really judge how the fund is doing. Motilal was under pressure recently because of the exposure it had to 1%, which actually was not a fault of the fund house. It was actually a fault on the sense from the company which didn't disclose data because the data didn't come out correctly and their auditors resigned. So they actually had a beating on their stock exposure. So that can happen to any fund. So I think you should give them a fair chance. It's not that Axis is not a good fund, but Motilal is also equally good.
Okay. His second question, Kotak Select Focus Fund is also not working well. It has become a multi-cap fund. Is it better to stay invested in that scheme or to change the fund? Please recommend a good large cap.
See, if you have done your kind of research on this, Kotak Select Focus, which is now standard multi-cap, was always a large cap bias fund. If you go back in history of this fund, it was actually a multi-cap strategy which actually got converted to a large cap bias fund. So currently this fund actually holds 83% large cap stocks. Now if you want to have only a large cap bias fund in totality or a higher degree of large caps, then you can actually look at an SBI blue chip or a Franklin blue chip, which are also large cap and hold more than 90% of their exposure actually is in large cap stocks. So pick your call, but in itself, Kotak Select Focus, Kotak Standard Multi-Cap, which is called now, is a good fund to be held.
Okay, Avijit's third and final question is, L&T emerging business is not working well in small caps. I have invested 2,500 per month for building a retirement corpus. Canada Robeco Emerging Equities is working well. Please give me your suggestion.
Avijit, same answer what I answered for Motilal and Axis. Both are excellent funds again. Both Canada Robeco Emerging Equity as well as your L&T Emerging Business. It's very hard to choose. I really cannot go and pick up the last 15 days or 1 month of performance to say, okay, this fund is not doing well, hence go for your Canada or L&T or vice versa. So if you have picked up L&T, which actually is a very good performance, stick on to it. If you want to add Canada, you can do that because there's no harm in adding 2 mid-cap strategies in the portfolio because of different functionalities, different fund management styles, different processes. Mid-cap space, you always an option to add couple of funds in your portfolio.
In fact, interestingly, Surya, one of the things that's coming out of Avijit's question is that how frequently should you be looking at switching from one fund to the other? It seems like all his 3 questions
are interrelated.
Yeah.
And my concern over there, good you mentioned this, Vivek, my concern over here is actually all the fund which he wants to exit are actually good performers. I really don't see a dip in their performances, maybe other than Motilal, which actually went down for reasons beyond their control. We really don't see a dip in performance of any of these funds mentioned, be it your L&T Emerging, be it a Kotak Select Focus. So 1%, 2% drop in the performance should not be the reason to actually go and change your portfolio just because you see the other fund doing well. Same fund cannot be number 1 permanently, and that's not the endeavor also. We should look at the benchmark and not the peer performance when you really look at the performance of any scheme.
Okay, so here's another question. Nutan Kumar Alikapati has this question. Mirai Asset India Opportunities changed from large cap to mid cap. Should I continue investing into it or should I switch to some other large cap?
See, it's a good fund. You have to really decide the strategy which you want to really hold on to your portfolio. If you think you can hold for long term, Mirai is a very excellent performer from the performance from both of the large cap as well as the mid cap funds. You just give it some time before you want to do a change. If you really want to be very, very specific on the allocations to your portfolio, you want to be very large cap specific, then you can move out in a pure large cap space. You can look at a SBI blue chip, Franklin blue chip, Kotak Select Focus. They're all large cap bias oriented funds having anything from 80 to 90% exposure in large caps. So you can actually start creating that portfolio, but for a long-term horizon, do look at some mid-cap exposure in your portfolio.
Okay. Here's a question coming in from Suresh KJ. I've been investing in SIPs for the past 5 to 6 years and have increased my SIPs over the years as and when my income increased. That's a great thing, Suresh. Keep doing that. That said, I do have a lump sum amount that I want to invest, about 10 lakh rupees, and not sure where I need to invest it. Do I continue in mutual funds as lump sum or SIP, or is there any other asset class I need to look at? Currently, I have a home, I have small investment in gold, don't wish to invest more, and the rest is all mutual funds, mostly via SIPs. Can you help?
I think, Suresh, you have done everything right over here. You are increasing your SIPs as and when your income increases. You have limited your exposure to gold. You already have a property of yourself. Most of your assets are actually in the mutual fund through SIP routes. And now because you have a lump sum, I think you can do something similar to what you have been doing in the SIP strategies. Do an STP. That's called as systematic transfer plans. It works equally like an SIP model. In case of a scenario when you have a lump sum money with you. So what you do in this strategy is you put your money first into a debt fund, into an ultra short-term fund, and from there the ultra short-term funds gets debited and the credit happens in the fund where you want to go to. So for example, if I want to opt for a Templeton scheme, I will opt for a Franklin ultra short bond fund, and from there I will do a staggered STP, systematic transfer plan, in the scheme where I really want to go to off Templeton. So you have to pick up the debt fund, the ultra short-term fund of the fund house of the equity scheme where you want to go to, so that there is an inter-fund switch is being happening. And you can time in such a manner, exactly like an SIP, you can even do a weekly, fortnightly, monthly STP and stagger it over the next 6 months to 1 year to create a similar strategy for your portfolio.
And if he has been investing in, say, equity or debt through his SIPs, he has some gold. Does he need to really look at other assets? Not that there are too many
I don't think so.
But he should be quite okay with putting in further money into
Absolutely. I think in the current space, Vivek, I think mutual fund is one of the asset classes which actually offers the maximum benefit to an investor with the least of trouble. So what will you do otherwise? You will pick up a fixed income product which actually the interest rates are not that strong enough, not that high enough. Yes, now they are going up, but so is my inflation. And they're all taxable products. Nonetheless, these are also taxable products, but they are more tax efficient and you are able to generate a little bit of alpha over the products provided you are able to hold them for a long term of period.
Okay, Biswa has this question. He says his portfolio is the following: Motilal Oswal Multicap 35, Principal Emerging Blue Chip, Kotak Standard Multicap Fund, Mirai Asset India Equity Fund. In the first three, he's putting in 2,000 rupees per month, and in the last one, he's putting in 1,500 rupees a month. His horizon is over 10 years. Wants to know if his portfolio is okay.
Good funds, Biswas. You have two large caps with the total exposure you have is 2,000 and 1,500. One multi-cap strategy, one mid-cap strategy. So good portfolio. Little large cap heavy, but I think that's fine because while you have a long horizon, it depends on your risk appetite, that how much risk you want to take within the equity space. So, but overall, good portfolio, good funds, you can stick on to the same.
Okay. Piyush Mathur has this question: how much loss can happen in a diversified fund?
That's very interesting, honestly, Vivek. There is no definition to define the losses you can have in any equity-oriented scheme. It could be even a balanced fund. So there is no limit to that. For example, take an example of 2008 when investors believed that, okay, markets cannot go down further. It just kept on going down. I have an absolute loss of 60% in a one single financial year. So as of March 09, there was a loss of, if I look at 2008, 2009 as a financial year cycle, the loss was in any fund was around 60% in a diversified strategy. So in case of a sectoral call, had the sectoral not done well, go back to 2000, go to the IT sector. The fall was 80%. So that's what we say. Prefer to have allocation to your portfolio so that in case of any non-performance in any of the categories, you are a little bit insulated. It doesn't mean that you are protected, you have a profit or your capital remains intact. That's the very nature of the equity asset class. It can perform only in the long term. Now, taking the same example, had you invested in 2008 and still continue to hold to that investment, despite a 60% down to your capital, you will still be at a 10% annualized return, factoring in the 60% of loss. That's the beauty and advantage of the equity asset class. The percolation period is actually long, provided you are able to hold over the long period of time.
Okay, here's a question coming from KJ Sonowal. Is it okay to buy an NFO? Question number one.
See, NFOs preferably should be avoided because, as the name says, it's a new fund offer. You don't know what the strategies of that fund is or the stated objectives. You don't have a performance track record because it's a new fund. So if something similar is available in an existing fund, why will I opt for a new fund? Unless something unique comes into play, which is sometimes it does happen. But other than that, I don't see a reason why you should invest in a NFO.
His second question is, as we know, all funds are not performing well. What does it mean? Is it that the fund's return is below the index return over 6 months or a year? And how can I understand if my fund is performing well or if it is underperforming? Please tell me how to review my portfolio if necessary. He has another question. If the size of the fund is growing or getting bigger, then how does it affect the performance? In that case, should I leave the fund or stick to it?
See, let's talk about what happens if the funds are not performing well. Last 6 months, 1 year, markets have not done well. If you look at this year to date, from January to now, markets have not done well. Mid caps have really taken the brunt and they've corrected a lot, but they also have gained a lot of momentum and returns over the last calendar year. So these are phases of markets. If the markets were very, very simple returns and you could predict the movement of the market like a fixed income, then why an investor will not come into this asset class which has the potential to generate a return of inflation plus your GDP growth, which means you can outperform your inflation. Just because you cannot predict this asset class in the short term space, you have to look at an allocation strategy. That's why short term, don't look at equities. We always say look at with a 5-year perspective. Last 6 months, 3 months, 9 months will not give you any clear picture. They're very myopic views. Do look at long term, and from a performance review, do look at their benchmark comparison more than the peer comparison, because in a peer comparison, the risk could be much higher or could be much lower, which could change the asset class's performance. So best benchmark is to look at its own benchmark objective, and that will give you a true idea how the funds have fared over a long period of time. Again, do look at long term as a performance review. Don't look at the last 3 months and then decide whether I want to add or exit the fund. And adding to your the last query of yours, size of the fund does matter, but what matters the most is the performance of the scheme. So even if a scheme size is very large and you're already invested in the same, then performance should be the yardstick and not the scheme size. Just because a fund manager is able to give you returns, having a very large asset size should not be a reason for me to kind of penalize him and get out of the fund. Performance, that's the criteria you should look at.
Okay. Some questions related to insurance have also come in. Mithilesh has this question. I'm 35 years old. I want a 1 crore term plan with accidental and critical illness rider. Can you please suggest the best term plan to suit my requirements?
See, when you talk about a best term plan, Mithilesh, you have to look at what is my cost of the product. That's one feature you have to look at. And second is your claim settlement ratio. That what is the percentage of settlement by the company? That gives you a fair idea that how much claims are being settled by the company. Subject to these two, there are many companies which are there in this radar. You can look at an ICICI, an HDFC, a Birla. So these are SBI also. These are companies which have actually a good track record, reasonable premiums. Mind you, they're not the lowest of the premiums, but they are very competitive. Prefer for an online term plan. So at your age, if I look at you are 35, having a protection till you are 75, which means 40 years of cover, an average 1 CR will cost you around 18,000 rupees. If you add another 1 CR of accidental death benefit rider, ADB rider, and 10 lakhs of critical illness, it will come to around 28 to 30,000 odd rupees of your premium. So just judge and take an online insurance policies, because this is adds a little bit of more cost effectiveness to your portfolio.
Rohan Gupta has this question. I'm 28 years old. I already have a term insurance and I have taken a critical illness rider with it. Should I buy a standalone cancer care cover, since in critical illness rider, cancer is covered, but only the major ones? I think he means cancer is not covered. I don't know.
No, but I think...
okay, the types of cancer.
Yeah, the types of cancer could be limited. I'm not sure about this, to be honest, Rohan, because the cancer is covered.
His question is, there's something more to it. And in one of the latest videos, I found out that a 1 crore health insurance will be available at the price of a 7 lakh insurance. Keeping this in mind, should I still buy a cancer care cover? I think, Rohan, you're referring to the interview that we had with Yashish Dhaya on the Money Mile, where he said that in the future, he sees rates going down to such an extent that what today costs for a 7 lakh cover will probably be available for a 1 crore cover. Now, that's not something that has happened. He has said very clearly that is something he expects to happen. So if you need to buy a policy, I wouldn't suggest you sit and wait. But do you need to buy that? Surya can answer that.
I think you should, if you already have a critical illness rider cover with you, there is no need to buy a separate policy for a specific ailment. You mentioned cancer over here. Because critical illness actually covers you. But if you really want to get yourself covered, there is no harm in getting it. But because you already protected, what you can do is you can actually add on to your critical illness. So that if you have a cover of, let's say, 5 lakhs or 7 lakhs, you can top it up to 10 lakhs or even 20 lakhs. And if you think that's very less, then you can even go for a specific policy. There is no hard and fast rule around this. So you have to be looking at yourself, your lifestyle, whether you want to get yourself covered for this particular disease. If you want to, you can just go ahead and have it.
Okay, there's a question from Padma Kumar Patil who says, could you please suggest a family floater policy for my pregnant wife having a less waiting period for pregnancy cover? I think if she's already pregnant, it's quite unlikely that he's going to get a cover that covers the pregnancy, right?
See, there is a minimum waiting period before you can actually claim the maternity benefit. And typically that's 2 to 3 years. And just for your information, Mr. Kumar, I think you should look at the maternity benefit as an added feature of an insurance policy. It's not a disease. And that's the reason why any insurance company do not cover it. It's available at call. So you have to have a minimum waiting period on that to get yourself eligible to take the benefit of the same.
Nutan Kumar has a second question. Which is your favorite pick among L&T Midcap and Canara Robeco? I would like to add one midcap in my portfolio over a horizon of 15 years.
Both are very good funds actually, Nutan. So I think take your pick. I think L&T has a great systems in place, processes, good fund managers. And so, and likewise Canara. Canara is actually very strong on the midcap performance. It actually shows it. So if you ask me, I'll actually pick up L&T.
Okay. Thanks, Surya. Like always, for coming by, taking questions of our viewers. If you have any question related to your investment, you can post it on the Money Mile page on Facebook and we'll be happy to take it up. We do try and do as many open houses as possible. You can keep sending us your questions. We'll be happy to connect with you live here on the Money Mile page on Facebook and answer all your questions with Surya Bhatia. Thank you very much.
Thank you.